And there we are. Let me first welcome. So welcome everyone. Today is Saturday, April 15. If you haven't filed your taxes, don't worry. You have until the 18th. Yeah, you have until the 18th to file your taxes. Be there or be square. Uncle Sam is not kidding. He is going to come after you. So just a quick reminder, today's tax day, but not really tax day. Why the 18th? Because today is Saturday. That's it. I was scratching my head thinking what good reason, but nah, it's just because it's a weekend. So until the 18th. But anyhow, this is Saturdays with Eddie. So we don't take too many breaks, even though we do take breaks every other week. This is for educational purposes only. We are talking about options and how to get there. We're talking about leverage, how to make a lot of money, how to not lose a lot of money, and how to work it. We use the TD Ameritrade platform. It's called Think or Swim. Yeah, think or swim, and there's no sinking involved. Just thinking. It's only thinking or swimming. Some people like to call it sink or swim, but yeah, it's think or swim. If you're using any other platform, that's cool too. It does not really matter what platform you use, as long as you figure out and you understand how to use it. That is the objective. Once you learn the fundamentals and you know what to click, where to click, when to click, especially that last part, when. Yeah, not even the how or where, but the when to click, then that's super important. Marlon wants to remind us that SPX beat the taxman. Yeah, that's true. SPX will take your money before Uncle Sam, right? If he has not already, and he takes it every other day, not just on the 15th, but if you're going to get a refund from SPX, good luck. Good luck. Yeah, any questions on that introduction? By the way, did I say it's for educational purposes? I'm not a financial advisor, and that you should not risk any money you cannot afford to lose. Yeah, good deal, good deal. All right, we've got a couple of things on our agenda. We've got analysis, how to want to analyze yesterday's SPX or the S&P 500. When I say SPX, I am referring to the S&P 500 index. The reason I'm breaking this language down is because this is a worldwide audience. It's watched by a lot of people, so I get a lot of questions. Can you break down what is DTE mean? So I'm not going to assume that everybody knows, and so I'll break it down as I go with it. All right. So SPX is the S&P E-mini 500. Sorry, not E-mini. Oh man, I'm confusing myself. I'm confusing it. SPX is the S&P 500 index. An index is a securities vehicle or an instrument that has got a lot of equities and other things inside it. For instance, if you want to trade Apple, you want to trade Microsoft, you want to trade Amazon, you want to trade some ETFs, you want to trade a lot of things, and you don't know which one, then the S&P combines all of those on the 500 best companies in the US, and then you can trade that. That's called an index. It is different from an equity in the sense that you cannot really own it, right? You can't own it. You can't say that I bought a piece of SPX, put it in my pocket, I am going to pass this on to my grandkids. No, you can't do that. However, if you wanted to do something like that, long-term investing, then you can buy securities that are not indexes. An example would be SPY. That's an ETF. An example would be Apple, Microsoft. All of those you can own, and you can own them in shares. You can hold them for a very, very long time. Historically, they've always gone up. Historically, we can say that with absolute confidence that if you buy it now, unless that company goes bankrupt, more than likely in 10 years, it will still be valuable and probably worth more valuable than it is today. So people tend to buy that inside of their IRAs or individual retirement accounts. They tend to buy that inside their 401ks or their brokerage accounts, or just, anywhere where you can buy shares. So you can hold those. You can gift them. They have value. They pay you dividends. They don't expire. Options, which is what we are doing today, options have an expiration date. They're a contract. They represent something which we call the underlying, right? That thing that is below, right? Below what that thing is being represented. So that's what options are. They have an expiration date. So if you have something that expires in 30 days, we could say that that is a 30 DTE contract. DTE here, DTE means days to expiration. Yeah, sound right. So DTE is the days to expiration. It means that it expires. It's like your insurance policy. When you buy your insurance policy, you're covered for a term, a period of time. Whether it's a life insurance policy, whether it's a car insurance policy, it has a term. You go buy your automobile insurance because the state of Georgia said you need it because before they can give you a tag, and you go buy a 6-month tag, 6-month insurance policy. At the end of 6 months, what do you have to do? Do you still have insurance? No. You got to renew it, right? Or whatever amount of time. So that's the thing we have to think about. When you are working with options, you've got two sides to it. At the very basic side, there's the buying of options. You are banking on something happening with the underlying. That is the premise upon which you buy a contract and work with that leverage. You're banking on the premise that something is going to happen with the underlying. Let's give an example, right? So I'm going to share my screen here now, and see, we're going to use the Thinkorswim platform. And let's see. This is supposed to be rocket science. We just discovered how to share screen just the other day. I'm kidding, you know that. All right. If you cannot see my screen, could you please scream out loud? If you cannot see my screen, I'll tell you what, just scream. If you can see my screen, just go ahead and scream. Let out that energy. How about that?
We can see it, but can you enlarge it? There we go.
Yeah. Good. Let the energy out. Yeah, good deal. So what I'm looking at, if you've never seen this is a chart of Apple. Apple is AAPL. That is the underlying. So I'm going to break this down, and I'm going to focus on folks who are just coming in, and then we'll speed it up a little bit, just so that the people who've been training for a while don't get too bored. But let's break it down. Let's spend about 5-10 minutes on this for your benefit. So you want to make money on this, and the way that you're used to, in case you have bought shares, if you buy one share of Apple, it's going to cost you about $165 today, right? $165.21 is how much it's going to cost you. The reason I know it's 165 is because I'm looking at the right side of my screen, and this axis here represents the price of this instrument, right? By the way, I'm using different words to mean the same thing. When I say the instrument, when I say the security, when I say the underlying, I say the stock, the ticker, the symbol, all of those refer to the same thing, AAPL, Apple, right? So you're going to hear them said you're going to hear different terms for it, but they all mean the same thing. So don't get confused. Don't think that she was talking about the instrument, not the ticker, right? Sounds like some big words. Yeah, they're all the same thing. Ticker, symbol, instrument, all of that. You get the drift. So when I'm talking about the price, this is the price of that instrument, which happens to be Apple, and it's going to be 165. It's at 165 at the moment. Does that mean it is always going to be 165? No, it goes up and down. So if you've been around charts for 5 minutes or so, you will realize that these candlesticks, they look like candlesticks. They are in fact candlesticks. When they are going upwards, they are represented by a green color, right? Green color, meaning that the price was going upwards. When they're red, price is going down. I'm breaking this down as simple as we can, and then we'll speed up a little bit. but they're representing the change in the price of the underlying. Here, I'm switching terms again. I was talking about securities, instrument, now I'm talking about underlying. So let's stick with one or a few. So the price here is going to change. If I buy one share of Apple at 165 and I want to make $10, I'm just going to wait until the price of Apple goes up by $10, right? Simple as that. Make sense? Yeah. Nothing rocket science about it. But if I want to use options, meaning I want to use leverage to make more money, and I still have just a 165, well, maybe I should have a little bit more. Let's assume we have about what? Somebody give me a number to work with. Give me a number to work with here. Who has a number to work with?
200.
How much?
200.
200. Give me four figures. I need four figures.
1,000.
$1,000 is great. That sounds like Mr. Walt Bell. Yeah, that's who that was. I can recognize that voice anywhere. Okay, so.
That's me.
Awesome. Welcome. I'm doing well. Thanks, man. Thank you.
Glad to be here.
Awesome. Cool. So we have $1,000 account. We've just been given $1,000 account by Mr. Bell here. So that's what we have to work with, right? And let's go back to the previous example here with Apple. If Apple is costing 165 and we have $1,000, so I'm going to say 1,000 divided by 160. Should we just call it, say 166, because there's a few, some commission sometimes. How about that? Can we afford 6 shares? If we bought 6 shares at 165.21, then that would cost us $991.26. We'll be left over with a little bit of change, enough to, for bus fare home. Yeah, because you need to go home. And then if Apple increased by $10, now you have 6 shares. So the profit here would be what? Can we say that it's 6 times 10 because Apple went up by $10 on each share? We're understanding how to make money, right? And how do you actually buy that? You just click on the price and say buy. So if I just buy stock and I say I'm going to buy 6 of them, notice here I'm going to do that. 6 shares, $165 is what the price is. That's a median. Push confirm and send. That would, give me some amount, right? Let's see what would happen here. Then that would be spending $990 at that point. Okay, at that point I'd be spending about $999, whatever. Yeah, that much. So now that we have that, $1,000 going to give us $60. How can we make better use of that $1,000? Right? How can we make better use? So let's introduce options. A quick note about how you make money on anything. How you make money on anything regarding stocks. Buy low, sell high. Right? You do the same thing when you go buy a bag of oranges from the farmer. You want to buy as low as you can, so that when you take that bag of oranges to the market to sell it, you're going to try and sell it for much higher than you bought it. Yes? That concept, hopefully that concept is very, very clear. If it is not clear, let's stop here and break it down. Is it clear or not clear? Let me see some yeses. How about that? Yep. Everybody's pretty clear about that. That'll give me a chance to answer a text here. So sell high, buy low. I like that also. So we either buy low, sell high, or we sell high and buy it low. At the, when you're starting out, you start off with buying. That's the simpler way to do it. So you'll be buying low, and then when the price increases, you sell, you make the money. The difference between what you bought it for and what you sold it for. Really simple. We learned these when we learned how to make lemonade and sell lemonade, right? Yeah. So how do we do this? We want to think about the contract. I'm going to buy a contract, understanding or theorizing that if the price of the underlying goes up by a certain amount, then my contract should increase in value exponentially. Keyword here is exponentially. Exponentially means as a multiple of. So we're always seeing these guys who are talking about, these guys and girls talk to us about, if you want to be in business, learn how to multiply, not just how to add. Yeah. Adding is for every day. It's for your neighbor. Yeah. If you're in business and all you know how to do is add, you probably need to get a job. Maybe you need to do something else. Instead, if you're in business, you need to learn how to multiply. That is how business is done. You learn how to grow things exponentially. So that's what options is all about. We're multiplying. So let's see some examples. I'm going to click on trade here, which is how I get to the options chain, right? Remember, I'm on Thinkorswim, so I just clicked on trade. And then if this tab is not already selected, the one that says all products, that's the one that I want to be on. So trade and then all products, make sure it's not on Forex Trader, Futures Trader, Active Trader, all the good stuff. The one that you want to be on is this one called all products. Yeah. So we're breaking it down for those who are seeing this one for the very, very first time, because this is a common question. And I'm realizing now more than ever that as people learn options, as people learn how to trade, the platform is a really difficult part of it. So I want to break it down so that it is not intimidating. So when you see it, it's friendly and you know what to click and you know where to click. All right. So I clicked on trade and then all products, and this gave me the options chain. I know I'm on the options chain because it says over here option chain. You see how I pull that one up, Byron? Yeah, it says options chain. I can't go wrong with that, right? I just picked up the first name I saw. So before I even click on anything else, right? All of these are not expanded. If I wanted to expand all of them, I would click that icon there, but I want to unexpand them. I want to show you what the deal here is. I've got a bunch of dates and I'm wondering now, what are all these dates? What do they mean? Where do I even click? Where do I begin? So these dates represent expiration dates. Yeah, they represent expiration dates. That means that if you're going to buy a contract, it has an expiration date, and this is the date it's going to expire. So I have a choice. I have a choice of April 21. I have a choice of April 28, May 5, May 12, and so on and so forth. And they have a certain number of days to expiration. I don't have to calculate that. The program or the platform calculates that for me, right? For instance, if I take the contracts expiring April 28, 2023, notice that the date format here is day, month, year in 2-digit format. Yeah, these guys are so confident of themselves, they don't care about Y2K. Anybody know about Y2K problem? Clarence, well, no, okay. I won't go there.
Yes.
Not gonna go there. Not gonna go there. So Y2K problem was an interesting one, right?
It was.
It was an interesting one. A lot of people, decided, let's get hitched before this Y2K comes in because you never know, right?
Mm-hmm.
You never know. You never know. Well, anyway, I digress. But yeah, this is 2-digit here. You get the joke on that one. But if we pick this 28 April 2023, and I see this number here called 13, that number is representing the number of days until that contract expires, right? The number of days. So which one should you pick? You've got 6 days, 13, 20, all the way right now up to 979 days. So if I divide that by 365, that's about 2.5 years, give or take. Yeah, plus or minus, mostly plus. So that's the number of days. Which one is the best one to pick? We're going to figure that out. So once you've picked a contract, I mean, a date to expiration, let's say I'm going to pick one here, 12 May 2023. This one seems balanced. Oh, let me start talking about one more thing. The one weeklies here, how is this different from the ones that don't say weeklies? It just means that this one recurs every week. For example, if it expires on a Friday, then every Friday there's an expiring contract for Apple. Yeah, and that's all it means. These ones that do not have the word weeklies means that they expire. They repeat every month, but we don't say monthlies. We just say, just list it out. But what about the ones? So does that mean that after 16 June, we're not going to have any weeklies? Is that the deal? No, that's not the deal. The deal is the contracts are built and released every so often. That's why when you come back here next week or the week following week, you're going to see a few more weeklies. You might even see some quarterlies, right? They're all the same. Don't worry about them. As long as it's listed in your system, it is available to trade. With a few exceptions, when it comes to the indices, there's some that expire in the morning, and that's a deeper discussion. We can talk about that one later. But what about the 100? Right? Nobody's asked about the 100. Anybody figure out the 100 yet? The 100 simply tells us how many shares does each contract represent, and that answer is 100. Right? That answer is 100. Got somebody at my door. Hang on one quick second. All right. Is the question on the floor is that number ever not 100? And for the moment, no, it is always 100 for options. So you might be wondering, why do they even put it on there if it's always 100? It never changes to 99. Come Monday, we're going to look at it and see whether it's 101, 102. No, it's going to be 100. But the reason it is 100 is because on this platform, you could also trade other instruments that this is not 100. I'll show you. So I'm going to go here to maybe ES, and we're going to look at these. Do they say the number? They don't say the number here. Yeah. But what if we traded something like ES, by the way, the number should be 50. It should be saying 50 instead of 100. Let's go to crude oil. I guess they're assuming that you should know what number that is. Yes.
Eddie, look at ticker VXX.
VXX.
Yep.
25 of 100. Okay, so this is an index, and this one says 25 of 100, and that could mean something else, right? So VXX is, I believe it is what is this? Barclays iPath S&P VIX what?
It's a ETF for the VIX.
ETF for the VIX. Very interesting. That means that it is not always 100. It could be in a quarter, right? 1/4. I have to dig into this one a little bit more.
Yeah. Look at the contracts on June 16th.
On June 16. Yep. Yeah. June 16. You've got two contracts. You've got one that is 100, and you've got one that is shares per contract and dollar value. Yes. So this one, yep, that one is. So I guess to answer Dora's question, the answer is no. Yes, they are sometimes not 100. So you have to learn how to trade these ones before you trade anything special. So I'm going to leave that for deeper discussion because I didn't do my research here beforehand. But I want to say that when you're trading futures, that number is not always 100. It could be 1,000. It could be 2,500. It could be 10,000. For instance, you're trading in ounces of gold or barrels of oil or bushels of corn, something like that, right? But when it comes to options, which is what this is all about, we're talking about shares of the underlying, in which case gold is going to be 100. I want to say that 99% of the time I used to, now that Byron, has shared this one, it could be a quarter, right? So thanks for sharing that, Byron. I'm going to look on that.
That one also just had a reverse 1-to-4 split last month.
That is what I think I heard, that a reverse split, which is not usually good, right?
Yeah, that was in March, I think. I think that was in March.
End of March.
Yeah.
Okay.
Yeah, the reverse split. Yeah.
Yeah, the
Yeah.
reverse is usually signifying something negative, but a positive split is good, but and I guess you could argue it both ways. A reverse split means that either the company is shrinking in size or something like that, or a stock split in the positive side could mean that the company is floating more shares. Actually, that's what it means. It's floating more shares, whereas the reverse means it's shrinking. It is consolidating the number of shares that are available to fewer by the amount of the split. So
yeah. So Ed, I don't want to get ahead of your agenda, but maybe if you can make a note on, I'm looking at this as possible swing trade. Since the VIX dropped down yesterday to about 17, about the
yes, it
lowest
did.
that we've seen in a while.
Mm-hmm.
And I think there's still some volatility ahead of us. So I was looking at possibly saying this DXX as a swing trade. So maybe at some point, maybe today, we could look at the bar chart history and maybe this is a good candidate for a swing trade for folks.
Cool. Yeah, we'll take a look at that. When the VIX is this low, as it approaches 15, it gives us a lot of opportunities for buying, right? Because the relationship between VIX and premiums and options is that as the VIX is reducing in value, meaning that that price is going down, it means that the stock prices are also they're doing what? Stock prices are going up, right? Stock prices are going up, meaning it's healthy, and the premium is going down. So the VIX has a relationship with the premium or the price of the value of the premium of the contract. So low VIX, low premium, higher prices, right? So about 3-4 dimensional there, right? Cool. Let's go back here to Apple and the options chain. I want to finish this thought process here. So which contract do we pick? And we said that there's a method to the madness about which contract to pick based on what strategy you're trying to achieve. If you're a regular short-term trader, by short-term, I'm talking about swing trading, meaning that your trades go longer than a day, then you don't want to pick the one that is the closest, the one that is close to zero or even zero, right? So day traders will normally trade 0 DTE or 1 DTE, right? Maybe up to 7 DTE. Swing traders, on the other hand, they will favor 45 to 90 days. So if we go with 45 to 90 days, then it means that the best expiration date we're going to pick here is 2 June 2023, right? Because that one says 48. 48. So that is 48 days to expiration, right? Okay. So if I expand that, then we're faced with even more choices. Oh my goodness, man. So many numbers, so many things. I think last week we talked about the columns that are here, and we said that there are usually more columns than you're looking at right now. So I have all these possibilities: last X, net change, implied volatility, probability out of the money, so many things that I could add to these columns. But do I need to? Maybe, maybe not. There is a class for that. But we settled on this really simplified column set, or set of columns that you're seeing right now, that includes just the delta, the bid, and the ask that you cannot remove, the expiration you cannot remove, and the strike you cannot remove. So 1, 2, 3, 4, 5. 5 things that you need there, right? 5 things that you need. Well, actually, can you remove delta? You can probably remove delta, but everything else, it has to stay. So now that we've gone past, we figured out where to find the options chain, we have figured out the expiration dates and which one to pick for now, right? For simple strategy, right? Remember, one rule for a set of strategy is not necessarily good for all strategies. So think about that. When you learn a rule about a particular strategy, you should understand that that rule does not apply globally everywhere. It's just for that strategy. So be, prepared to have a flexible, some flexibility, understanding that the rule may change, will most likely change when you move on to the next strategy. So for now, we're going to pick 48 days. And now you're faced with all of these strikes, right? Notice that we have the strikes. They are going from smallest to largest, and they're even demarcated by different backgrounds, all that good stuff. What does that mean? So now we have to talk about moneyness. That's a new word, came out last week. Moneyness. Anybody ever heard about it? Yeah, moneyness, right? So the moneyness is we are referring to at the money, in the money, and out the money. So again, there's a class for that. But hopefully I'm breaking it down for people who have not seen these, or who have maybe just kind of opened these and scared to even click on something. You haven't bought anything yet. We're still going to buy something using the $1,000 that Mr. Bell gave us. So how do we make money using that 1,000? So I'm going to formulate a thesis. First, I'm going to go to the charts, and I'm going to say, you know what? I think that Apple is going to, let's theorize here, since we're beginning, this is the very first time we're learning options. We don't know how to sell. We only know how to buy, or we are thinking in terms of how to buy. So let's go with a buy example. And we theorize that maybe Apple is going to increase from 165 to 170. This is just a hypothetical number, $5. It's going to go from 165 to 170. It's an example, right? I'm not saying it will. This is just an example. And we're arbitrarily saying Apple is going to go from 165, 166, so on and so forth, up until 170. It could go higher. We've seen it go up to 176. We are only interested in that 5 points. You with me so far? If you have not traded options, is this making sense yet? Yeah, so far so good. We have not done anything. So how do we make money on that $5 movement? We know with shares, if we bought it at 165 and sold at 170, we'd make $5 per share. But we only have $1,000, and that would give us just 6 shares, right? Is that what we said? 6 times 165. Yeah, that will only give us 6 shares. So if it only goes up $5, then that means that we'll only make $30. It's not exciting. $1,000 to make $30. It's all right, but that's not the intention. Let's see what would happen if we applied the same principle to options. I'm going to choose an at the money contract over here. So who gave us this money? Mr. Walt. Is Walt here? Walt, are you still here?
Yes, I'm still here.
$1,000. Can I get another $100, please?
1,100.
Yeah.
All right, 1,100. We are at it.
Deal. This is the good thing. When you have a friend who is a banker, see, all it took is an ask, right? Why did I ask for an extra $100? It's because my contract is going to cost me $10.85 in premium. So let's break that down. What does $10.85 in premium mean? It means that I'm not going to spend $10.85. I'm actually going to spend $10.85 times 100, because one contract represents what? 100 shares. So the real value that I need inside my account is 1,085. 1,085. That's why I had to go back to my bank and say, dude, man, I only had $1,000. Can I get another $100 to top up my account so that I can afford these? So I need $1,100, or I need 1,085 in order to buy this contract. So that's what we're going to do. We're going to buy this contract for $10.85, meaning 1,085. And then that's going to be, let's see what we have here. Share my screen again. Number 3. Yep. So that's going to allow me to buy the 160 contract, right? 160 contract for that much. Yeah. We switch accounts here again. Give me one quick second. Yeah. All right. Good. I'm sorry, I'm switching screens over here just to make it a little comfortable for myself. So I'm going to buy these, and I can afford just one for now, right? And I'm going to push confirm and send. So illegal. All right, why is that? Okay, all right. See, okay, let's choose. Let me stop sharing one more time.
Eddie, you're in your live account, right?
Yeah, that's I am.
Oh, okay.
I am. I was having trouble with I'm using a small account here that I usually play with. So
Okay, I just wasn't sure if you wanted to push that, confirm and send.
oh, it won't go anywhere. It's a weekend.
Oh, okay.
Yep. It's won't go anywhere. So let me see one more time whether I can go into I know what to do. Never mind. I have a better idea. A better idea. I'm not sharing my screen, am I? No. Not yet. Okay, good. We pick a time when Thinkorswim is usually doing their updates. So that's always a little tricky. All right, I have switched into something called On Demand. On Demand is a feature of Thinkorswim that allows us to simulate plays. So I'm going to click on the calendar here and fast forward to 2023. We are in the month of April. Today is April 15, and we should have data as of, let's go with Monday. How about that? Yeah. So it is pre-buffering. And once it comes back over here, then we will have data for that day. Cool, we do. So I'm going to switch gears here. 45 to 90 days. Let me see whether this is still a good deal or not. See whether this is still a good deal. Yeah, it's a good deal. But luckily, Mr. Bell already gave us $1,100. So we're good to go. And let's look at the charts one more time here. So the price here is 160. Price is falling down. And we're still going to go with the same thesis that we expect price to go up. Remember, if you're starting options, you go with the simplest strategy first, which is buying. So we're not going to talk about selling just yet. We're just going to talk about buying. So we expect that price is going to from 160 and end up at 165. We'll go with the same, $5 point movement, and let's see how we can take advantage of that. So I'm going to go to my options chain, pick a date that is between 45 and 90 days. I see the number here, 46, that qualifies for between 45 and 90. And then I'm going to buy at the money, the 160 contract. So we're progressing through several things. First, we looked at the chart to see what direction do we think the price of the underlying is moving. If it's going up, we're good. Next, we need to pick an expiration date that is 45 to 90 days, done. Then we need to pick a strike. So this is where now you need to know which one do you pick, right? Which one do you pick? And I'm picking the one at the money. So you have to know what at the money means or what out of the money means, or in the money. In a nutshell, everything that has a black background on either side, either the calls or the puts, is out of the money, right? Out of the money, meaning that if you flip yourself upside down and throw out your pockets, you have no money. It's a good way of looking at it, right? Out of the money. But if you're loaded, you still have your wallet. It's got some cash, which is rare these days. I just read somewhere the average amount of cash in people's wallets is $67. How did they come up with that? Any idea, Tommy? How did they figure out that people have $67? Because they didn't ask me. They didn't ask me. The average amount of cash I have in my wallet is $0.00. I don't know where they came up with 67. So anyway, in the money, out of the money. So everything that has a purple background is in the money. The one that is in the middle is considered at the money, meaning that is a 50 chance it's going to expire in the money, right? More about that later. But 160 is the contract that I'm going to pick because it's the first one in the money. It is going to cost me $730. I'm going to click on the ask column, and it has a delta of 55. This is important now. We decided that we are going to go for about $5 worth of movement in the underlying. The underlying here is Apple, and we need to know how much each dollar movement is going to give us. And we can multiply that by the amount of delta. So I'm skipping a lot of stuff over here, but walk with me here. There's more to this. So 50 every time that the underlying increases by $1, then the value of this contract that I'm buying at $7.35 is going to increase by 55 cents. 55 cents in premium is actually $55. Does that make sense? So I'm simply going to click on that. I'm going to buy just one contract, 735. I'm going to confirm and send. Okay. My max loss is the amount that I'm investing here. Let's go ahead and send it. And I just bought one at price went down, 725. It was a limit order. Why did I get filled at something different? When I clicked 735, I got filled at 725. Why did I get filled at an amount less than what I had said? It's because when you send a limit order, you're saying, give me this price or better, right? Additionally, when I clicked on buy, I'm going to do this again. I had my padlock open, meaning that I was telling the system, give me some flexibility. If you can find a better price in the market, go ahead and do it. But if I had locked that padlock, that would have been equivalent to me telling the system, I want to buy at that price and no different price, exactly that price. So it is to your advantage when you're buying to have the padlock open, and then it will always get you either that price or a better deal. So right now we are $7.50 in profit. I'm going to stop over here for questions, just for those who maybe are doing this or watching this for the first time. You have questions? Anybody have questions so far? You all are good. All right, we'll speed it up.
So why is it in profit?
Why is it in profit? It's in profit because the price has moved up from 725 and the price is now something else. What something else is that? Let's read this. I have a quantity of one right now, 46 days to expiration. My trade price was 725. The mark is now 735.
Oh.
Right? Meaning that the price of the underlying is moving in my favor. And remember, I bought it for 725. The price is now 732. So it's automatically calculating how much am I in profit. Make sense?
So this is a projection?
No, this is not.
Since you're in on demand.
Mm-hmm.
So is it just projecting that that's the amount? Or
no, it is actually telling me what actually happened.
Oh, okay.
Yeah, because I'm pulling in data from April the 10th
Oh, okay.
to see how did things work out on that day. So I'm simulating if I had bought one contract of Apple at 725, what would have happened at that particular moment? And it is showing me that the progression, as price moves up and down, obviously there's fluctuation here, and I'm on the daily chart. So if I wanted to see the actual fluctuation, I might go into the 15-minute chart. Okay, so I'm going to go here to 5 days, 15, and you can see that price is kind of moving up and down, mostly up. Yeah. So my thesis is that price is going to go up, and as it goes up, I am making more money. Is that right? And I want to go up to 165. So how will I know how much to sell when it reaches 165? What will that premium be? That's a question we want to answer, and we have to know this. This has to be part of your trading plan, because we said earlier on that we buy low, sell high. Yes. We know what the low is. The low is the $7.25 that we spent. But what is the high? How much high? What is the value of that high? The way to calculate that high is to see what the delta was at the time that we bought it, and which I believe it was. Did anyone take a note what the delta was? Oh, let's just take it 55 for now. It's 55, and we're expecting it was 55. Okay. And we're anticipating that this will go all the way to 165. That is our theory. So that represents $5 worth of movement of the underlying. We also know from a fundamental knowledge point that every time the price of the underlying moves up by $1, then this premium is going to increase by the amount of delta. So go up by 1, we add 55. Go up another 1, we add 55. That's just a straight line calculation. In real time, or in actual fact, that number could fluctuate based on the volatility of the market. But let's take a straight line calculation here and assume that every time it goes up by $1, we increase it by 55 cents. We might as well just say 55 times 5. Is that right? Much easier to do that, right? So 0.55 times 5, I'm expecting that this premium will increase by 2.75. All I did was multiply 5 times 0.55, and I saw that the premium should increase by 2.75. So we're still at 160, and the value is let's stay with the 725 that we purchased this options contract with. So at the end of $5, that premium will now be worth what? 725 plus 2.75. Let's do some quick math over there. Can we say that it's going to be worth $10? Yeah, $10. How did I get to $10? Simply 0.55 times 5 give us 225. We added that to our purchase price, give us what? $10. Do you notice that the delta is also increasing? And we talked about that last week when we said that delta is influenced by gamma. Gamma is the rate of change of delta, right? And gamma is also influenced. So let's go ahead and set our sell order. So I'm going to move over here to the monitor tab. It's the very first one to the left of trade. Down here, I should see a section called equities and equity options. And then I will see my instrument here. Usually it's going to be unexpanded like this. Right now I am negative 2.5. Well, now I'm break even 0. By the way, when you see the number that is in parentheses, that means that you're losing that much money. But it is not set in stone. It's not crystallized yet. It's not a crystallized loss. Or a more familiar term, it is unrealized. It is only realized when you close the position. Then you've locked it in and said, that's it, you stop here. But for as long as this position is alive and breathing and kicking, then it's going to fluctuate up and down. So to close it, since I did not enter a bracket order to begin with, I'm going to close this manually, or I'm going to submit a closing order. And the right way to do it is to simply right click on this instrument, see what it says, create closing order. And I'm going to select the only option that I have. And it gives me this sell order. Let me clean up this space over here so that you can see what's happening. So this is a sell, it's a single, -1, meaning that I'm going to be getting rid of 1. By the way, you notice that the color of this leg is actually red, meaning that we're selling something, yeah? And then the price, by default, it gives me what the current price. Now, this is lower than what we bought it for, right? If we sold it at 7.15, are we going to make money or lose money? Let me look at the chart here. Nobody knows. Wow.
I believe
Lose.
we're gonna make money because
gonna
it's
make
less than what we purchased it for.
So we're going to make money or lose money?
We're gonna make money.
Buy low, sell high.
Mm-mm.
Or buy high, sell low on a put, right?
This is a call.
Oh, okay, it's a call. So buy low, sell high on a call.
We're
Well,
losing money.
Yeah, we're losing money. So
We're
even if
losing
it was a put, we should be expecting that the value of this contract should be increasing if we're going to make any money. So this is where this is an important concept to grasp. The instrument that we're trading is the contract itself. And its value is being affected by the price of the underlying. The underlying here being Apple, and this is the price that we are expecting to drive the value of this contract. When we bought this, it was at 160. It's still about 160 and change. And we can see that it is fluctuating up and down. Remember this candle here was green a minute ago, or several minutes ago. But our theory is that we want it to go up. That's our thesis. And for as long as it's going upwards, then we are making money. But if it's going down, we're not. If we put in an order here to sell at 7 or 7.05, we'd be losing money. How much money exactly would we be losing? Let me go and lock this in so that we can discuss about it. We paid $7.25. In order for us to make money, so now I want you all to tell me, should we sell it more than $7.25 or less than $7.25?
More.
Definitely more, right? Yeah. Resoundingly more. Yeah. So since we're not done yet, we don't want to sell it now. We're just setting up an order here. And we decided, or we calculated that if the price of Apple increases by $5, then the value of our premium will have gone to how much? Just did the math here a minute ago.
275.
It will have gone up by 275. So the new value will be what? 725 plus 225.
$10.
$10 is right. Yeah. We're simply setting up the sell so that the system does it for us. We don't have to sit in front of the computer and watch it like paint drying. You just want to make sure that the order is in the system. And there's one field over here I want to talk about. It's the one that the TIF. TIF stands for time in force. Let me talk about that because that's super important. Time in force refers to how long this order is going to remain in the system, remain and be active in the system. If the time in force is day, it means that that order will drop off forever at 4:00 p.m. Eastern time. Is it possible that at the end of the day, Apple might not have gone all the way to 165? Is it possible?
Yes, it is.
It is possible. So we need this order to persist more than just today, right? And in order for that to happen, we need to tell the system that we want our order to be good for 90 days or until this condition is met. So I'm just simply going to click on this and change to GTC. GTC stands for good till canceled. Now, good till canceled does not mean that the system is going to hold this for a year for me. No, it's not. It will hold it for 90 days. Yeah, 90 days. What's a good example? What's a good analogy of that? It's like layaway, right? Do layaway still exist? Is that still a thing?
Yeah, around the holidays.
Yeah. Well, basically, you're going to a store and you're either putting some money down or you're telling them, go ahead and hide this in the back of the store so that when I come back, I will pay for it at the price that you have today. It's like layaway. So I'm like laying away this price. Wow, I never thought about that. Yeah. So yeah, I think Swim has got layaway price. Layaway. That's crazy, man. That's crazy. Yeah, I don't know why I find it so funny, but anyhow, we're telling the system that for 90 days, this price, so I'm going to confirm and send. And this order is going to be executed once the price reaches $10. At the moment, we don't know what the price is. So let's go to Monitor tab and see where we are. And let's read this because this is so important. I just realized that this, I somehow knew all along, but this week it became even more apparent for me that a lot of people are getting confused with this section. So let's talk about this section. This section is the Monitor tab where you understand how things are moving with your trade. You already entered the trade, yes. Now we're in the part where we are in the managing the trade part of it. We're trying to figure out what's happening. Am I losing money? Am I making money? Do I need to do anything? So do anything we've already done. What is that? We've placed a take profit order. This is called a take profit order, right? Because we are selling. Do I have a stop loss? No, I don't, not yet. Where is my trade so far? Then I can look in the PL open to see that right now I am still at zero or break even, meaning that the price that I paid, that is what the current price in the market is. You see where it says mark. Mark is also the last price. So if you have it on your platform, the mark or the current price. So I'm making $0 right now because I paid $7.25. The contract is still worth $7.25, and that number is changing. Yeah, it's changing as time goes. But the good thing is I have a take profit order. Now, is that enough to protect myself? No. So let's add some risk management. Risk management here means that if this order does not go the way we want, then we need an automatic exit. That's the smart thing to do. We need an automatic exit. So since I cannot put in a stop loss after I've put in my take profit, then the best way to do it is to remove this take profit and modify my exit strategy so that I have both a take profit and a stop loss. So how do we cancel this order? Simply going to right click on this anywhere on this red line. First option here says cancel order. It's gone. Now I don't have anything. All I have is an order that is just there. I don't have a take profit. I don't have a stop loss. So here's how you do a stop loss. I'm going to go back down to my equities and equity options section. I'm going to right click, create closing order again. Right, create closing order again, comes over here. Let me clean up this screen here. But this time, I'm trying to remove as much noise as possible so that you can see this. But this time, I'm going to change this from advanced single order, and I'm going to make that one OCO. Remember, I'm already inside the trade, so those choices will be different if you are not inside the trade. So as long as you're inside the trade already, or rather you've been filled, then you want to choose OCO. Next thing I'm going to do is I'm going to make a duplicate of that, and simply right click and create duplicate. Now I've got two orders that look exactly the same. It's getting nuts, man. Why do I want to do this? Well, bear with me here. So the first one, we're going to call this our take profit order. And we say that we're going to sell these at $10. And by the way, these need to be GTC, both of them. The next one, we're going to change this from a limit order. We're going to choose a stop. And we're going to choose a number here. Somebody remind me, we bought these for what, 725? 725. How about we risk 100? So if we risk 100 and we bought these at 7.25, at which point, what is the value of this contract going to be to signify that we are down $100? Somebody type it into the chat, please.
Would it be 625?
625 would be about right. Yes. Right. So just to elaborate what that means, we bought these for 725. If the value is going up, we're good. If the value is going down, no bueno. So at 625, that will be exactly $100 in the red, at which point we will have reached our pain point and said, you know what, it was a good ride, but we're not willing to lose more than $100. We don't know that it's going to turn around, but we're not comfortable anymore. Our rule says that if the value goes down to 625, we are out. Make sense? So that's the number that I would put in here as a stop. So now I've got a take profit. So if the value of the contract goes up to $10, we are going to sell at $10. We will have made $275 at that point in time. But if the value goes down to 625, we will have lost $100. By comparison, if we had bought 6 shares, we wouldn't be worried if the price goes down to 150. We just need to wait a few months or a few weeks. Price is going to come back up again, right? But with shares, we are time bound. We have 46 days for this thing to be right. Yeah, because we have 46 days to expiration. So we have to have some rules that say if it goes down this far, we're not making money. Or if it is in profit, where do we take the profit? Okay. So I'm going to push confirm and send and look at everything. Now I have 2 orders. I've got a take profit and I've got a stop loss. Send. Where did all that stuff go now? Well, I'm going to go back to my monitor tab. Notice that I've got 2 working orders and I have a chain linking them, meaning that they are mutually exclusive. Only one of these can happen. Either the take profit, which is the best case scenario, or we get stopped out at 625, we lose $100. I'm going to pause there for questions. Anybody lost? So I can drop the mic here.
That's just a basic example of risk management with your stop loss.
Absolutely. Absolutely.
Yeah.
Yeah. Nothing more to think about. It's a set of rules that you're following. And for as long as you stick to those rules and you understand what your risk profile is, because this is very subjective. When it comes to risk management, it is subjective, but there's common sense as well. For instance, if you were expecting to make $200, then you don't put a risk of 300, right? If you are expecting to make $1,000, then you can maybe risk 300. But in this particular case, we are targeting to make $275. So our risk here it has to be less than 275. But we don't want to risk the whole thing, right? We don't want a 1-to-1. We want something closer to a 3-to-1, 2-to-1, something greater than 1. So $100 risk here is it would be good. I think it would be sufficient. that was the easy part of it. That was the basics. That was the we talk about the options chain. We talk about learning the platform. There's a whole lot more. Look at some of my videos on Think or Swim. So let's move on to the next one so that we can close. SPX. So, oh, let me read the chat, make sure that I don't have anything here. I think we're good, right? By the way, if you want to learn this in a more deeper sense, if this is your first time watching or you're watching this after the fact, optionswitheddy.com. Let me type that in the chat. Is where you'd learn about this. And my next class is, I think it's May the 8th, optionswitheddy.com, or you can email me info@optionswith. Yep. That's how I've got a private message there, but that one just posted publicly. That's how you get a hold of me. So who wanted to learn about what happened? Was it Lauren? Lauren, you wanted to learn about what happened yesterday? Was that your question?
Yes.
Okay. So yesterday was first off a doji day. How do we know it's a doji day? Because the candle ended up right in the middle, right? Small body in the middle, almost equidistant from the very top and from the very bottom. That's a doji. It means that price went all the way up and all the way down, came back up and rested in the middle. In a nutshell, that's what happened for that candle. If we want to see what happened during the day, we go down into a lesser time frame and we can start to analyze what happened. Yesterday was the 14th, so we started here. It appears based on this first green candle, looks like we gapped down. So let's understand how this happened, right? So the previous day, we stopped at about 41.46 and change, give or take, right? That's where we stopped. The following morning, we started down here at 41.30 something, 39, give or take. Maybe we can, 41.38.94 is exact. And we know that because this is a green candle. And when we look at green candles, the opening is at the bottom. Right? So charting 101, the opening is at the bottom if you're looking at a green candle. If you're looking at a red candle, the open is at the top. There's 4 parts to the candle: the open, the high, the low, and the close. So this one opened down here, went up, kept going up, followed by another 15 green candle, then came all the way down and all that. Everybody can see that. Nothing special, nothing fancy about that. The question is, what was happening? What was causing all of this? Well, yesterday was an interesting day because we had some numbers released from Forex, right? We had some numbers released by the FOMC or other bodies. Core retail sales month over month, retail sales month over month, import prices, all of that. And we even had an FOMC member speaking. And then early morning, we had the preliminary University of Michigan consumer sentiment. I think this one was important, probably more important than the core retail sales. But that was what was driving the market. So when you are trading, more specifically the S&P 500 index, you want to be aware of what is happening around the world and more specifically what is happening here in the US. You notice that my Forex factory here is actually filtered. I could see all of these, and then I'd be looking at what's happening with the euro, the franc, the Canadian dollar, and all that. But I'm not so interested in that. I'm just interested in what's happening right here in the US. So I filter these on just USD. Okay, just USD. Lauren, help me understand. Let's be more specific. What are you looking for here? Because we analyze before the market opens. It's easier to analyze. For me, it's easier to analyze before the market opens. That way I can have some projections about what might potentially happen, rather than look at it from a 2020 perspective in hindsight, because it's pretty straightforward.
I was looking at getting into a put, but it didn't look favorable. I mean, I kept looking at it, but it didn't look favorable, especially this one down here, like where it went to 41.15, I guess.
Mhm.
Around there. Well, I was trying to get it on the way down. I started in the morning,
Mhm.
but at one point, I know what happened. We were saying if you didn't get in then, you're chasing it, which I felt like I was doing. So
Mhm.
my intuition said, do not do it. So I didn't. And it looks like that was right. I mean, it, because I was going to wait and get in at the proper, like around 11 o'clock, and it wasn't looking good at all. And I just wanted to kind of confirm that my thoughts on it were
Yeah.
accurate.
Well, the movement yesterday, we understand the volatile movement was because of all the activity going on. And usually when we have that much activity, we stay off the market, especially if we do not understand it. So you can see that it went all the way up, went all the way down, came back up, like make up your mind. And then it ended up kind of at the same place it started in the morning. But one thing you said here is that you have absolutely stellar intuition. I love your intuition. You called it correctly. You did not feel good about it, and you were correct. Lauren, I think I'm going to put you on my team. How about that?
How about that?
We're going to be
That's
asking,
funny.
Lauren, do you think the market is going to go down? Nah, I'm hands off. Lauren said, market is not going down. I mean, that intuition was right on. It was on point. What would have happened if she had not trusted her intuition? It means that she would be in a put, and right now she'd be bleeding because what happened? Price went up, and she was talking about the 41.15. You're right. You would have been chasing it, right? Then you'd have fallen victim to the classic. I enter and it immediately turns around. Anybody's done that? Every one of us.
Yeah.
Has. Yeah, every one of us has. So to help you out, Lauren, what you want to do is, instead of trading at these micro levels, by micro, I mean looking at the 15 and making your decision based on that. Instead, what you want to do is go on a macro level and go to the daily time frame, right? So the daily time frame is going to give you some more information about where is the price trending, and you want to be as you want to analyze this as close as possible to it is trending upwards over the next several days, or it's trending down over the next several days. Yeah. Once you identify that, then your play is going to be for the longer term. It is not going to be for that day or the next day. It's going to be for what? If you're trading the S&P 500, it's probably going to be for the next 2 weeks. So you want your analysis to cover the next 2 to 3 weeks. Then once you enter that trade in that direction, you don't have to worry about the intraday fluctuations, because those are going to give you heartburn real quick.
That's where I have the problem.
Okay.
Because I'm listening in one ear, we're saying, oh, this moves so fast. If you do this or that, then you can, be profitable. But if you wait too long, you won't, you won't, and that kind of thing.
Yeah, it's because we're trying to trade a swing trade. Or rather, we try to do a swing trade, but we have the mindset of a day trader.
Right. Okay.
So remove that mindset of day trading and understand that When you trade, you're trading for the longer term. It has been proven over a very, very long time that those who buy and hold, or those who trade for the longer term, actually do much better, a lot better than those who trade for the shorter term, right? Because there's so many opportunities that you could trade in the short term, but if you're getting in, maybe you might not even get out at the right time, then you're down. But if you had waited maybe 1 hour later, you'd been up. Those are the mentalities of a day trader. So stick with the swing trading, make your decision based on the overall health of the chart, and decide maybe in a couple of weeks, we're going to complete this upside down V and the price will maybe be somewhere around the 4,000 area, right? How long is it going to take? Maybe 2 or 3 weeks. So your contract needs to be a little longer than that so that your thesis has time to work. What happens in the middle of the day, don't worry too much about it because your trading horizon is not 6.5 hours. 6.5 hours from 9:30 to 4 o'clock. If you're trading inside of that, and that's where you're living, that's a very stressful place to live. So I would go for the longer term. But then you might say that if I bought a 30-day contract on SPX, I'd be paying a lot of money. Well, you would be right. You'd be very right, because that does cost a lot of money. So maybe SPX is not for you. Go with something else that is less expensive, less volatile, but still gives you decent returns. Figure out what a decent return is. Is it $10? Is it $100 or $500? Whatever that decent return is, again, based on your account value, your portfolio value, right? So trade on a day, not on the, or rather do the swing trades rather than the day trades. That's what I favor. Hope that helps.
Yes.
Cool.
Thank you.
You're welcome. Yeah, today we spend a lot of time just breaking down simple fundamentals, options 101 stuff. A lot of you have been trading for a while, so it was probably a little bit boring, but you know, we're covering most people here. So, any questions, especially for those who have not been trading for a while? Just starting with options. If not, we're going to wrap up the day or open it up for any more advanced questions, maybe a couple more minutes. And it looks like we're good. All right, guys. So, yeah, go do your taxes. Don't be late. April 18.
Jerry, I have one quick platform question.
Sure.
Yes, it's simple, but it always bugs me. In Thinkorswim, what's the easiest way to track your day trades for those who have the PDT rule to contend with? Let's just say you use 2 of them and you want to know when they come back.
Okay, yeah. So easy way is when you click on at the very top, right? Am I still sharing? Hopefully I am. Yeah. So at the very top, when you're inside your live account, if you go to the particular account, and you know it's possible that you have more than one, so click the particular account that you need to get information on, expand the account info, top left, and it should say number of trades left.
Right. Yeah, I'm tracking that, but I'm just saying, like, let's just say if you use 2 on, say, last week, but you can't remember exactly when you actually executed those round trips, and you want to know when they're gonna be available to you again.
Got it. Okay. Another good question. So what you want to keep track of, and the easiest way to keep track of is if your first trade, let's assume you had all 3 available. Yeah. If your first trade is today, let's assume today is a Monday, then your next available trade is they're going to drop off. That the 5-day period is going to drop off after 5 business days, right? So Friday is going to drop off. So Monday, you will have all three available again.
Correct.
Actually, you may or may not. Let me think about that. No. Monday, the one that you used on Monday, let's assume today was Monday. The following Monday, today's trade would be available, and so on and so forth. So it's a rolling 5 business day count.
Not including any non-trade days, holidays.
Affirmative. Yep, that is true. So don't count holidays, don't count weekends. Even if the holiday falls, say, on a Tuesday, don't count those days. In fact, a good way to count the days is, simple question: is the market open? If the market is open, that's a business day. If the market is closed, not a business day. But the best way probably to keep track of what's happening with that count is to continuously monitor that number of trades left or available. So I wish they had a lot. They should have.
You can add that shortcut too. That setup, platform setup, that gear over in the right-hand corner.
Yep.
And then put it up along the top
So what's the
tab
short
area where the time is. When you go back to your regular account, right now you're in on-demand.
Mhm.
But yeah, you go there and is that it? That may not be it. Well, we're in on-demand, but my point is you can go to the settings and add that widget to tell you how many day trades you have. And it'll tell you the number of day trades that you have left in that 5 business day period. You can put it across the top of your screen next to your cash sweep and that other info that shows up on the top tab when you're in your regular account.
Yep, that is true. I actually know what she's talking about because I removed mine on purpose. I did not want it showing there because it also shows some additional information there. And so I purposely hid it. But that's another way, Marlon, for you to have a continuous view of how many trades you have available. And remember, that will give you more accurate information once you switch to the appropriate account, because you might have more than one account, right? So you want to make sure that you're looking at the right account and it's going to give you the information for that account. So
That sounds great.
yep. And
Okay.
Jared says you can also add it to your mobile version. So mobile app.
Awesome. Thank you so much. I appreciate it.
Hey, no worries, man. Absolutely. Absolutely. All right. Anybody else have a question that we can tackle? All right, well, good. Cool. So if you haven't joined the alumni options with Eddie, go ahead and join that. You might want that. Next, May the 8th is the next class. There are a few classes in between that are already full, but May the 8th, we have availability. Cool. All right, guys, I am done for this Saturday. Let's see who's still on.
Thanks, Eddie.
Cool.
Thank you.
Cool.
Yeah, thank you, Mr. Eddie.
You're most welcome. Most welcome.
Thank
That was-
you.
All right.
Thanks,
Have a-
Eddie. Appreciate it.
You're welcome. Have a great weekend, everyone.
You too.
Eddie, have a good weekend. Oh, good rest of the week.
Thank you. Thank you.
Thank you.
You take care.
All right, bye.